when you think about where you're taking risks and what part of the bond market action doesn't make sense in this context, I think it really is around that break-even inflation.
That's what I was fishing for. So.
Welcome to the weekly Macro Sunday podcast, your independent macro podcast each and every Sunday. My name is Andreas Steno. I'm the founder and CEO of Steno Research, and I'm joined by Head of Research here at Steno Research today, Emil Miller. Welcome.
Cheers, thank you.
And in a few minutes from now, we'll invite a great macro thinker, Bob Elliot, former investment committee member of the Bridgewater hedge fund, for a discussion on U.S. inflation, the yield curve in the U.S., and how to play it from here. It's been a big inflation week, Emil. So why don't we start with a brief discussion on inflation trends around the globe? We are recording after the release of the U.S. CPI report. Not really a game changer for market, is it, Emil,
No.
by the looks of it?
No, because it was pretty much on spot with consensus, right? I mean, I don't have any major takeaways from it. That's why I sort of was hesitant to lay out any massive claims prior to the release. No, I think generally speaking, we're just getting confirmation that the disinflationary trend is structurally ongoing. I think that's basically what you need to know.
Yeah, and it will be tricky to get to 2% as well in the US. I think the details of this inflation report sort of reveal that as well. And I think it's one of the topics that have not been covered enough in global macro. The reason why the US inflation is sticky relative to, for example, the European HICP methodology. So, Emil, we've looked into this topic over the past week. On a top-down basis, what's the difference between how you measure inflation in the US and in Europe?
So generally speaking, the shelter component, which it's the cost of shelter, and we all need it, and of course it should be accounted for in the inflation measure, right? But that takes up like a big lump of the entire index in comparison to what we see in Europe. And shelter costs tend to be lagging. And therefore, it's sort of, if you're going up or down really fast, that tends to pin you to where you were coming from. I think that's sort of a way to think about it. So that's the main thing to be aware about.
So if we look at the European HICP and compare it to the US CPI or PCE methodology, we're now, say, trending at 0.2, 0.3, maybe worst case 0.4 month over month in US inflation. If you take the inflation ex shelter, we're much closer to zero in the US. And the interesting thing here is that if you compare that to the HICP in Europe, we probably have a couple of percent on an annual basis in the services component, but the rest is a mixture of food. Energy is no longer inflating, and it will deflate even further year over year in Europe. And then finally, non-energy industrial goods. So it's much more goods-based. It's much more based on food, and it's also based on energy, the inflation that we've seen in Europe relative to the US, where you have those, both the service component, but also of course, the shelter part of the service component being much more, with a much more large volume, you can say, relative to what you see in Europe. And the point here is that if those cyclical trends in inflation wane fast, and we've seen that in the US, and probably we will see that over the course of the next 2, 3, 4 months in Europe as well. The likelihood of European inflation printing below 2% is much higher than it is in the US. That's my takeaway.
Yeah, I agree. Unless we see a real estate market crash.
In the US at least. So ultimately, I think the sort of cocktail of inflation information that we have at this juncture probably hints of the European Central Bank pausing, pivoting ahead of the Fed here, which is not what you expect typically.
No, but we've been on this. I wrote an article not that long ago about the nature of the difference in the shocks, and I think this is just an extension of it, to an extent, right? Because not only is Europe more prone to, or the European index, it has this goods component as well, but also we're energy importers, right? I think that's another thing to be aware about when we think about the economy as a whole.
Yeah.
We compare the two. So but I will say is if you've been attending university like you and I have, and you've been working with CL,
Debatable.
yeah, fair play, and you've been doing calculations on the basis of whatever exogenous inflation measure you've been given, you don't really put much effort into thinking about, well, inflation is not really an objective identity, right?
No.
But if you look down to the crux of it, you can start to see the differences.
Emil, we need to remember to have a laugh here at the Macro Sunday.
Finally.
So I've found a clip on inflation from the stand-up comedian Sammy Obeid, I think it's called. So let's listen to Sammy and get back to the inflation in China, because that's negative.
Yeah. I just found out that I have a friend who doesn't know what inflation is yet. I was like, how you feeling about this inflation? He's like, that's like balloons, right? I was like, oh no. Oh, this is not looking good. I was like, how do you not yet know what inflation is? He's like, oh, I remember they first started talking about it. It was scary. But then they kept talking about it, and now I've heard the word inflation so many times, it's lost all its value. I'm like, man, I think you just defined inflation. He's like, whatever it is, I don't buy it. I was like, oh, there we go.
But Emil, over the past week, we had the final confirmation of actual deflation in China.
Yeah.
Minus 0.3% annualized inflation.
Yeah.
So, I mean, is this something to worry about, also for us Westerners?
To worry about? No, I don't think so. I think I read an article by, I think it was JP Morgan, who made some calculations on what this will mean for goods pricing in the rest of the world, and they basically came up with an additional deflationary effect in goods, and I think they got to around 70 basis points, something to that measure. But what we should remember is it's a year-on-year print. If you look at it on a month-on-month basis, it's actually accelerating a tad. So there are some nuances to it.
Yeah,
to be sure.
And the PPI bottomed in China, which is obviously of relevance also for goods pricing down the road. Yeah. And we probably should expect PPIs to bottom now that we've seen an increase,
in energy,
broadly speaking, in energy, but also industrial metals, etc. Yeah. And I think this is a great opportunity to invite Bob Elliot to join us here at the Macro Sunday podcast. Bob is a great macro thinker, a risk taker of nature, a long career at Bridgewater as one of Ray Dalio's lieutenants, and no one's better than Bob at elaborating on macro strategy in an inflationary environment. So let's get Bob introduced to the podcast, and as per usual, we play a piece of music every time we invite a guest onto the Macro Sunday floor here. And given that his name is Bob, I found one of my old favorite songs from Outkast called B.O.B. Bombs Over Baghdad, I think. So here's Bob, and here's Outkast. Introduce Bob Elliot to the Macro Sunday podcast, former member of the investment committee at Bridgewater, and now the CEO and CIO of Unlimited Funds. So great to see you, Bob. Thanks for joining us.
Hey, thanks so much for having me. Congrats on the new podcast. Very excited to be able to join here in the early days and contribute my small piece to what you're up to.
Cheers.
Thanks so much, Bob. I mean, we're recording hot on the heels of the US CPI report, and it was sort of a mixed bag of goodies with headline reaccelerating in annual terms and core inflation decelerating in annual terms. So what do you make of this odd cocktail, Bob, here short term after the release of the report?
Well, I think the report itself has, a little bit of something for everyone, like many of these reports. And so, probably if you're scrolling through Twitter this afternoon, you'll get a lot of takes, positive and negative. For me, what I'm really looking at uh, is thinking about the sort of durability of the disinflationary dynamic that we're seeing. And so, a couple things that stood out to me in terms of the report was that a lot of the sort of low inflation pieces of it were relatively extreme. You had like relatively extreme declines in airline prices. You continue to have relatively extreme declines in used autos. Those things can lower measured inflation, is how I'd say it, but it doesn't
Mm,
necessarily mean that that's actually creating a big disinflationary impulse on the economy. And so instead, instead of looking at this particular report and tearing it apart, I'm sort of looking forward and I'm saying, look, we basically have in markets and sort of the prevailing narrative, which is that we're in this disinflationary trend that's going to get inflation basically close to where the Fed's target is. And I look at that and I say, the risk seems skewed to the upside on that when you consider that wage inflation continues to meaningfully outpace productivity growth in the US economy. And when you see the rise in oil prices and energy prices, it hasn't been a huge rise, but going from disinflationary impulse to an inflationary impulse will have a forward-looking impact. And so that's what I see as the pressures skewed to the upside rather than a benign meandering to the Fed's target relatively short.
But when we look at components like used autos and airfares, etc., I think you wrote earlier this week on Twitter that you considered sort of number crunching on for example used autos to be sort of consensus thinking on inflation. So what do you mean by that, and why is it relevant to sort of set such effects aside?
Yeah, well, I think the key thing, and we all sit here and try and we're trading markets, and when you're trading
Mm,
markets, um, if you're trying to generate alpha, right? If you're trying to generate returns that are in excess of, passive investing, the way you do that is you have to have a view on what's likely to transpire that's meaningfully different from what's priced in. And so I think and too often people think that a consensus view is a good indication of a position, right? But they don't look at whether that view is actually priced in the market. So if we look at the market right now, what do we have? We have 6 cuts priced into 24 at this point. We have 0 cuts or zero hikes in 23, 6 cuts in 24. Disinflate, 12% earnings growth expected in 24 as well. We have like the perfect soft landing priced into the economy. So if we
yeah.
get data that suggests that soft landing might happen, then so what? It's already priced in. The important question, if you're trying to navigate these markets, is what isn't the market considering effectively? And so that's why I think people are gonna, there's going to be a lot of takes about things we already know, and not enough takes about what are the markets missing, where could be the risk points, and are those risk points on the upside or on the downside relative to that Fed target.
But if we look at inflation X shelter, Jay Powell has used such metrics in his communication in various press conferences, etc. It seems like inflation is more or less gone outside of the shelter category. What do you make of that? Is it relevant to look at inflation X shelter, or do we need to take shelter into account on an ongoing basis here?
Well, I think, first of all, shelter, like people do pay for, their houses and to rent
clearly.
properties. So like this idea that like, well, we shouldn't look at shelter is pretty crazy. Like talk to anyone renting an apartment in New York and, shelter is the first thing that they're going to be talking about when it comes to prices. And those prices are high. That's all I've got to say about that. And so I think it's a bit disingenuous to just totally toss aside shelter prices. At
Mm,
the same time, there are other things that are probably more indicative of the structural inflationary pressures in the economy than like lagging OER imputed calculations and rent calculations. And so that's why it does make sense to look at other aspects of the various measures. So, for instance, Powell has talked about the services X housing piece of
mm,
things. Well, I think for instance, very interesting in the CPI report, if you take that services X housing segment of the market, and for CPI, there's a goofy thing related to medical insurance. So if you take that out, you're looking at an 0.4 reading for July, right? And that's actually not that surprising, because services X housing is mostly driven by wages, and wages on an hourly basis are growing at about 4 to 5%, and productivity is growing at about 0 in the US economy per hour worked. And so the gap between those two things should be the structural inflationary pressures in the economy, particularly related to services. And that's essentially what you're seeing, which is the structural services X housing inflation is about 4 to 5%. The gap between wage growth and productivity growth is about 4 to 5%. And that really is the core, if you let me go with the pun, that's the core issue of the U.S. inflation problem, is that dynamic, not the actual measured core inflation.
Bob, as one of our clients replied on the chat when I shared this chart on inflation X shelter, thank God I'm homeless, right? So of course you cannot set that part of the inflation basket aside, right? I wanted to
I just live in the WeWork here in New York, so I don't have to pay rent, right? Just right here in, I don't have the beautiful sauna to be taking my podcasts in. I just have a cramped WeWork office.
But Bob, I wanted to get your take on the dollar yield curve in relation to this inflation discussion. We've had early moves towards a steepening of the curve over the past 2 weeks, and then sort of a reversal of that trend over the past week again here. It seems like the market is sort of struggling to find direction in terms of flattening versus steepening of the curve. So given your view on structural inflation, where do you see the curvature heading here?
Well, I think this is one of those cases where you really have to break down the two different pieces of the curve to start to think about the steepening or flattening. What is the Fed doing? And the Fed has been pretty clear that that they're not going to meaningfully tighten anytime soon. Now, there's a question about whether they'll do all the cuts that are priced into 24 and early 25, but over the next 6 months, there's not going to be a meaningful repricing of what's going on. Powell is right now essentially everything's priced out in terms of any more hikes through the end of the year, and so I actually think what you're basically seeing on the front end is a reflection of that reality. Now, that might be a good choice or a bad choice by the Fed, and that dynamic might change. But the Fed's, let's just say, their decision-making process is something that takes 3 or 6 months to play out, not something that's going to change, minute to minute in terms of taking in that incoming data. And so I think you in many ways, you sort of have an anchored short end that's probably not going to move around very much anytime soon. And then what you have is the sort of long end pressure. And, it obviously 2 weeks ago got a lot of press about what's going on with the amount of government supply and the amount of, duration issuance that's going to come into the market. And that's created a pressure on the long bond, which makes sense, combined with the fact that, if who knows whether this is exactly right, but if real GDP is growing at 4.1%, the way the Atlanta Fed is suggesting, which is probably overstated, just to be clear. But look, forget 4.1%, 3%, 2%. All of those are well above potential. All of those should put pressure on the long end, and that's, I think, basically what we're seeing is the acknowledgement of the macroeconomic reality that the Fed's not going to do much anytime soon. The economy's pretty hot, and that should create a steepening of the yield curve. Now, the steepening of the yield curve has its own influences. Steepening, and particularly a bear steepening of the yield curve, has its own influences over time on the economy and might create the downturn down the line. But the ordering matters, which is you get the steepening, you get the bear steepening. That's the first step before you get the slowdown in the economy.
And how do you see positioning in relation to the potential steepening of the yield curve? There's been a lot of discussions on whether the CFTC data is telling in relation to the positioning in the bond space. It is kind of upside down to a lot of surveys, for example, the one conducted by JP Morgan suggesting that the market positioning is heavily long duration. So what do you make of bond market positioning at this juncture?
Yeah, I mean, I think basically what you see is you see a big disconnect between sort of the real money managers, the traditional money managers who are, I think, what that JP Morgan read is sounds about right, which is that they're pretty long duration, and frankly have been out there talking about how to be long duration since the beginning of the year, or late last year. Every time you turn on one of the financial news shows, it's a big name asset manager, a person from a big name asset manager saying, 4% bonds are the best deal I've seen, in my professional career, or at least in the last 15 years. And so that's not surprising. I think when you look at active managers, and, at Unlimited, we have this insight into what hedge funds are doing and how they're positioned. What you see is that actually they're quite underweight duration, not nearly as extreme as what we saw last year, where they were very much ahead of the game in terms of the bond sell-off, and were not meaningfully short duration as that happened and got paid handsomely for it. Now I'd say they're basically, a bit underweight duration relative to their norms. And so I think that's basically what you're seeing is some cautiousness that we're going to have to see higher bond yields in the short term from, the most sophisticated asset managers in the world. That's kind of how they're netting out, which is, pretty different from what we see in traditional asset managers.
The current cocktail of, say, rising energy prices, at least early signs of a bear steepening of the yield curve, and sticky inflation pressures when it comes to wages. Where does that leave risk assets, Bob?
Well, I think, it's not. I think it's a challenging dynamic, because I don't the overall picture. Where does that leave risk assets in general? I think the answer is basically where they've been for the last 9 to 12 months, which is, if you look at a balanced portfolio of risk assets, go look at our par, it's basically chopped, right? Since late last year, it's chopped sideways, which means basically assets in general are kind of flat. And I think the reason why that is while the Fed has tightened and liquidity has tightened a little bit in the market, it hasn't been enough to actually create a deleveraging, a sucking out of liquidity out of the market. Actually, there's still a reasonable amount of liquidity floating around, right? So that private sector leveraging is helping offset some of the Fed tightening. I think the more interesting story is across assets. When you see that dynamic that you're describing, what does that look like across assets? And I think what you see is the story you're describing, which is the Fed a little bit behind the curve and not doing much in general, is quite good for commodities. It's not that bad for stocks, but it's terrible for bonds. And the reason why that is because as long as the economy remains strong, right, you're not gonna get this sort of acute interest rate cuts that are necessary to get that acute bond rally, right? You're gonna get bonds combined, the economy combined with the supply issues meander up. Stocks will probably do better than bonds, because if the economy's okay, earnings will hold up relative to expectations, right? So they'll do a little bit better. And the best asset out there is commodities, because what's being priced into commodities is a collapse in growth, and that is not transpiring on a global basis. And I think it's very interesting, super interesting in the market action of the last couple of days. What we see is oil prices. What's been the best asset over the last couple of days? It's been commodity prices. That's fascinating, right? That's a fascinating dynamic, because it really shows how this cross asset dynamic is transpiring and reflecting that set of conditions you just described, Andreas.
Bob, I'm really happy you said that, because we're long commodities, and that's
Good.
yeah. So I don't know if you have any particular opinion on it, but I'm curious anyhow. Inflation expectations and commodities, that juncture. Where do you think we are, and where are we going here? If we
Well,
look a quarter,
the inflation expectations, again, to kind of get down to the nuts and bolts of the market.
yeah,
When you look at that bond yield in the U.S., right, you're looking at the bond yields are made up of two pieces: the inflation expectations and the real yield. When you look at the real yield, you see real yields, across the curve that are still somewhat inverted, 3 to 2, let's just say, across the curve. that's pretty high. Like, relative to history, that's a pretty good, that's a pretty good real yield. Particularly on the long end, it's not quite as good as the threes we saw in the early 2000s, but it's pretty good. I think the thing that doesn't make a lot of sense in this overall context is a break-even inflation expectation of basically 2% forever, or maybe 2.25% forever. And so when you think about where you're taking risks and what part of the bond market action doesn't make sense in this context, I think it really is around that break-even inflation.
That's what I was fishing for. So,
Bob, I will allow you your potential famous last words on this podcast. Given all we've discussed, sticky inflation, commodity prices now on the rise again, a bear steepening of the yield curve, is it time to call off all that chatter on the recession?
Well, I think what I'd say is that going back to that conversation that we were having, which is you have to think about where you're positioned relative to consensus.
Yeah.
Like, back last year, I was saying, hey, look, this economy, it's got too much momentum. We're not going to have a recession. And the consensus was recession now. And I think in some ways we've like meaningfully flipped. It's translated that there's been no recession. But now, people are all in on soft landing, no landing, forever growth, 3% growth, et cetera. And I'm looking at it and going like, no, that's not how this works. Like, there's a cycle, it takes time. But as you see the interest rates rising, as you see the credit standards tightening, as you see all these dynamics play out, like, you will see a weakening of the economy, and you have started to see that weakening of the economy. And so this idea that we're going to have no landing is a totally crazy idea. Like, that's not how this is going to work. Like, we are going to get to recession. The question is how fast. And I think the answer is, a little later than even I suspected, 9 to 12 months ago. But it's within a time frame, of 6 to 9 months, we'll be starting to have that conversation, is my guess. But the timing, the calendar timing, I think, is less important than the ordering. And that's really what I'm focused on right now, which is the ordering is first yields have to rise, then asset prices have to sell off, then we get to our recessionary dynamic. And so that's what I'm really laser focused on, is if we continue to get these yields rising, this bear steepener, that's really the indication that we're going to start to get to those recessionary forces emerging more acutely, relatively soon in the 6-month time frame. And so that's kind of the focus, is more the ordering than the calendar read.
Good point.
Yeah. Great summary, Bob. Bob Elliot, CIO of Unlimited Funds. Thank you very much for being with us here at Macro Sunday.
Thanks for having me.
Back after the interview, Emil, great guy, Bob. Hilarious guy, actually. I love his personality, on top of his great knowledge around macro strategy. But Emil, listening to Bob here, it sort of seems to me that he expects yields to move first now.
Yeah.
Then we get a reaction in risk assets, and then ultimately we can discuss the recession, layoffs, and all that. Yeah. Do you think that playbook sounds familiar or feasible?
Yeah. Well, yes. The only thing I'm sort of questioning, or starting to question, is whether we will see a sell-off in equities and layoffs in isolation first. It's not my base case, but I think the risks are there. But yeah, I completely follow his line of thought. Absolutely. It's a really interesting perspective. Yeah.
And this is the part of the podcast where we get to boil it all down into actionable trade ideas. And in this edition of the Macro Sunday, I forgot to disclaim that our trade ideas may be...
Sometimes may be good, sometimes may be shit.
We probably need to play that a couple of times a week at the moment. But we've actually been on top of the sort of rotation into energy, into commodities, which has saved our portfolio quite tremendously from the turmoil that we've seen over the past 3 weeks here. And interestingly, Emil, we've been looking into what happens in in an environment where the yield curve steepens.
Yeah.
And I guess it all depends on whether it bull steepens or bear steepens
Yes.
from a cross-asset perspective. So from the data that we've been able to gather, Emil, what do you make of that that yield curve environment and how to view it?
Yeah, it's a good question. I think for now, I think the market is starting to get the gist of, okay, we need to see a steepening in the yield curve. I'm not completely committed to to the drivers behind it.
No.
The only thing I'm really sure about is that we are going to see a steepening. But what I will say is that plenty of headwinds for equities, which I don't think. Well, Bob, he didn't really get in on it. I would have loved to pick his brain on a couple of things, but I think that whole area sort of is the prerequisite for a bear steepening. To be quite frank with you.
So when we look at data
Mm.
on returns in equities in various yield curve regimes, the best regime for equities is actually a bear steepening regime. So long-term bond yields rising for the right reasons, you can say.
Yeah.
A cyclical upturn, commodities rising, while a massive bull steepening, so cuts from central banks, panicking over layoffs, is the worst case scenario, essentially.
Yes.
So a steeper yield curve can either bring about tremendous returns or abysmal returns.
It's all about the drivers. But if you only invested in the yield curve, it doesn't matter. Well, there are some risk adjusted returns that you should. I mean, you might want to just be long the bonds if everything goes one way. But yeah, you're right. That's sort of the drivers behind it.
Yeah. And I guess if we look at cross-asset ramifications of a bear steepening or a bull steepening, we also get a mixed signal for the US dollar in these back tests. If we are indeed in a bear steepening scenario, that's my base case right now.
Yeah.
Then the dollar gains versus the yen quite materially, but the dollar weakens versus some of the more cyclical currencies such as the Aussie, the NOK, etc. And more or less vice versa in the bull steepening scenario. But I guess to a certain extent, with a relatively tricky environment here, the steepener is probably the best risk reward, and then you do not really take into account whether it's one or the other type of steepening, right?
I think so. I think so. Or you just long the short end. That could be another thing if you do want to cover. But I think this moment in time is super tricky, and I'm not completely confident that average back test is necessarily the one guide to rule you here. But yeah, you should take it into account for sure.
But we've seen a spike in natural gas prices over the past few days here, on top of oil prices accelerating over the past month or two. And the trigger this week was the announcement of strikes in Australia related to a few LNG facilities. And I think it goes to show that the supply is still extremely tight. I mean, an announcement of a strike and then all of a sudden European gas markets freak out. Obviously because we compete with Asian LNG flows, given that the supply is tight. And I've looked into the supply of natural gas on a running basis in Europe. The amount of natural gas arriving in Europe on a daily basis is still, say, in between 30 and 35% lower than just ahead of the invasion of Ukraine. So even as this LNG adventure, so to speak, has been able to sort of make up for large parts of the loss from Russian flows, we're not there yet.
No, but a dark horse here is how adjustable is Europe to import less gas. We saw that last time around, that we could actually depend on other energy sources, and we could move a few things that we didn't expect.
Coal,
right?
Yeah.
But I also think this speaks into a larger trend, which is the conflict between workers and firms. And right now we are at a juncture where workers want real wages back. And if you are selling natural gas and you can demand some money, and perhaps the laborers have a really good, like they got some leverage.
Yeah.
But if you're doing it in a sector which has a negative outlook on the economy and perhaps suffering from, pressures from the financial side and whatnot, that might be, gauge to unemployment. That's one thing to look out for.
It is. But I'm still relatively comfortable with our long positions in energy stocks and in broad commodities. And I think we see tailwinds from this natural gas story as well.
Yeah.
One thing I'd like to add in relation to this natural gas story is that maybe natural gas is the true explanatory variable behind what's going on in the euro versus the dollar. We've been trying to short Eurodollar a couple of times over the course of the spring and early summer, with mixed results, so to speak. We one home run and one miss, and I'm tempted to say that we're about to enter a more structural bear case for Eurodollar again.
Yeah.
And let me elaborate why. Because the current price of natural gas in Europe, the main benchmark TTF traded in Holland, is around the price is around 42 euros per megawatt hour, and the break even for the European trade balance is around 50. Yeah, so we're getting close to a trade deficit scenario for Europe again, and that massive trade deficit, or energy deficit rather, through the autumn of 22 was basically the main driver, the main catalyst behind the weak euro. And the reversal of that trend when natural gas prices declined again was also a main catalyst behind DAX performing again, the euro performing again. So the whole euro asset landscape is very much defined by this natural gas story at this juncture.
Yeah. And then you should also take into account that the industrialization story hasn't really filled out to its full potential.
No.
I mean, there's still layoffs in the pipeline and plenty of worry down in Germany and subsequently France a bit as well. So I think generally I struggle to see anything positive when it comes to the outlook for European economy. It grieves me to say.
If you're an FX portfolio manager at a large institution, I think it's relatively safe to say that if you short Eurodollar in your hedging benchmarks and go fishing for 12 months, then you will have a different return than your peers, because all of your peers are long Eurodollar in asset management space right now.
Definitely.
The CFTC data is extreme right now when it comes to asset manager positioning in the euro versus the dollar. And that's why I like the structural bear case. I'm not saying that it's a short-term tactical trace, but the structural bear case is relatively compelling here. Emil, the final thing I wanted to discuss with you is an odd one out in this podcast. So I'll introduce this final theme of the podcast with a piece of music from my childhood. Here
lovely.
It goes. Joking aside,
I can't even share what I've lost to this song.
Emil, it's actually a bit inappropriate to laugh about Ecuador, because the backdrop ahead of the election there is quite tragical. Basically, we've seen a killing of one of the presidential candidates.
And it just goes to show how unstable the political climate is down there, and how the power struggles within the country are just accelerating. I've done this dive into sovereign risk in Ecuador, which is a bit exotic, but I'm an EM guy, so that's what I do. And I think I found quite a compelling case, and then all of a sudden this occurs. And I think to myself, sell off. And this, exogenous, weird risk that could happen, it can happen, and but cynically to say, actually it has basically so far worked as a catalyst for
performance in Ecuadorian
that long position. So and you should remember Ecuador is a dollarized economy, so from an EM perspective, if you are a Western PM, you you don't need to hedge it. So
Yeah.
what makes it
Don't
attractive.
take this as a
No.
suggestion if you're long dollar duration.
No.
I mean, let's at least allow Biden to to die naturally, I'd say. Joking aside, Emil, it's I think the ultimate discussion here is whether LATAM is an interesting region still, given all of this turbulence. We've been trying to dip our toes into Brazil. We've had great luck with positions in Mexican peso and reals over the course of last year and into the early stages of this year. But the turbulence has started sort of spreading to at least the FX component of the LATAM story.
Yeah. I think the Bank of Japan basically pulled the rug from it. And the steepening of the yield curve is essentially just kryptonite to some of these currencies, right? But I do think that once you get that shock into the markets and you have that sell-off, you sort of recuperate and ask yourself, okay, where are we going from here? And I'm sort of at the juncture where the economies in Latin America who are cutting rates are perhaps getting a weaker substantial case, but there are still some who are struggling with inflation, and I think they will keep on fighting it. That's why I'm sort of looking into Colombia at the moment, actually.
Okay. Yeah.
So yeah, it's a diverse map at this moment in time, definitely.
It is, and I think we will leave it at that for this edition of Macro Sunday. Thank you very much for being with us, Emil. My name is Andreas Steno, and I'd like to remind you that this is just an appetizer to the load of material that we create on a weekly basis here at Steno Research. And as an exclusive offer for the audience, you can use the coupon code MACRO30 to get access to our full research offering with a 30% discount. We hope to see you as clients soon. Or in any case, thank you very much for listening in to this edition of the Macro Sunday. We'll see you again next Sunday.